Welcome. Today, we're diving into the relationship between taxes and PCE inflation. PCE, or personal consumption expenditures, inflation is a key measure used by policymakers to track changes in the prices of goods and services consumed by households. Understanding how taxes influence this metric is crucial for grasping the bigger economic picture. In this video, we'll break down the basics, explore the mechanisms at play, and see real-world examples of how taxes can impact inflation rates. Let's start by understanding what PCE inflation actually is and why it matters. PCE inflation measures the average increase in prices paid by consumers for goods and services over time. Unlike other inflation metrics, PCE takes into account changes in consumer behavior, such as substituting cheaper products when prices rise. This makes it a more flexible and comprehensive indicator. The Federal Reserve closely watches PCE inflation to guide monetary policy decisions. Now that we know what PCE inflation is, let's look at how taxes fit into this picture. Taxes come in many forms, including income taxes, sales taxes, and excise taxes. Each type affects consumers and businesses differently. For example, sales taxes are added directly to the price of goods and services, while income taxes reduce the amount of money households have to spend. These differences are important when considering how taxes influence overall price levels and ultimately PCE inflation. Sales taxes are perhaps the most straightforward way taxes affect PCE inflation. When a government increases sales taxes, the prices of taxed goods and services rise immediately. This increase is reflected in the PCE index, as consumers pay more out of pocket. Conversely, a reduction in sales taxes can lower prices, reducing measured inflation. The direct link between sales taxes and consumer prices makes this tax particularly influential in the short term. Income taxes don't directly change the prices of goods and services, but they do affect how much money households have to spend. Higher income taxes mean less disposable income, which can reduce demand for goods and services. Lower demand can in turn slow price increases, putting downward pressure on PCE inflation. On the other hand, tax cuts can boost spending and potentially push prices higher. Excise taxes are applied to specific products like gasoline, tobacco, or alcohol. When these taxes increase, the prices of affected goods rise, which can show up in PCE inflation if those goods are part of the consumption basket. While the overall effect may be smaller than a broad sales tax, excise taxes can still influence inflation, especially if they target widely consumed items. PCE index includes taxes that are embedded in the prices consumers pay, such as sales and excise taxes. However, it does not include income taxes, since these don't directly affect the price of goods and services. This distinction is important for understanding what changes in the PCE index actually reflect and how different tax policies might show up in inflation data. When a new tax is introduced or an existing one is raised, businesses often pass these costs on to consumers in the form of higher prices. This process, known as tax pass-through, can vary depending on market conditions and competition. In highly competitive markets, businesses may absorb some of the cost, but in less competitive markets, consumers bear most of the burden. This pass-through effect is a key channel through which taxes influence PCE inflation. Impact of taxes on PCE inflation can differ over time. In the short term, a tax increase usually leads to a one-time jump in prices. Over the long term, however, the effect may fade as consumers adjust their spending habits or as businesses find ways to offset higher costs. Understanding this distinction helps policymakers anticipate how tax changes will affect inflation trends. Let's look at a real-world example. When a country raises its value-added tax (VAT), the prices of most goods and services increase. This leads to a noticeable spike in PCE inflation in the months following the tax hike. Over time, the effect may diminish as the economy adapts, but the initial impact is clear in the inflation data. Another example is an increase in excise taxes on gasoline. When this happens, fuel prices rise, which can push up transportation costs and indirectly the prices of other goods. This ripple effect can be seen in PCE inflation, especially if transportation is a significant part of household spending. On the flip side, tax cuts can have a deflationary effect, especially if they reduce the cost of goods and services. For example, a temporary sales tax holiday can lower prices and slow inflation, at least for a short period. However, the overall impact depends on how widespread and significant the tax cut is. Consumers and businesses don't just passively accept tax changes, they respond to them. Higher taxes may lead consumers to buy less or switch to untaxed alternatives, while businesses might adjust their pricing strategies. These behavioral responses can moderate or amplify the impact of taxes on PCE inflation, making the relationship more complex than it first appears. When taxes make certain goods more expensive, consumers often substitute cheaper alternatives. For example, if a tax raises the price of sugary drinks, people might switch to water or juice. This substitution effect can limit the overall impact of taxes on PCE inflation as consumers shift their spending to less taxed items. The degree to which taxes affect prices depends on market structure. In competitive markets, businesses may absorb some of the tax to keep prices low, while in less competitive markets, consumers may bear most of the cost. This concept, known as tax incidence, is important for understanding the real-world impact of tax policy on inflation. Not all prices respond to tax changes immediately. Some businesses may delay price increases due to contracts or fear of losing customers. This phenomenon, known as price stickiness, means the full effect of a tax change on PCE inflation may unfold gradually over time, rather than all at once. Expectations play a big role in how taxes affect inflation. If consumers and businesses expect higher taxes in the future, they may adjust their behavior now, buying goods before a tax hike or raising prices in anticipation. These expectation-driven actions can influence PCE inflation even before a tax change takes effect. Central banks like the Federal Reserve set inflation targets to guide economic policy. When tax changes push PCE inflation above or below target, policymakers may adjust interest rates or take other actions to keep inflation in check. Understanding the link between taxes and PCE inflation is essential for effective monetary policy. Different countries have different tax structures, which can lead to varying impacts on PCE inflation. For example, countries with high consumption taxes may see more volatile inflation rates when those taxes change. Comparing international experiences helps us understand the broader effects of tax policy on inflation. During economic crises, governments may adjust taxes to stabilize the economy. For example, temporary tax cuts can support consumer spending and limit deflation, while tax increases may be used to raise revenue. These policy moves can have significant effects on PCE inflation depending on their timing and scale. It's important to note that not all inflation indexes treat taxes the same way. The Consumer Price Index (CPI) and PCE Index both measure inflation, but they differ in their coverage and methodology. For example, CPI may include some taxes not captured by PCE, leading to differences in reported inflation rates. Sometimes, large tax increases can cause noticeable surges in inflation. For example, a major hike in sales or excise taxes can lead to a sudden jump in prices across many sectors. These surges are usually temporary, but they can have lasting effects on consumer confidence and spending patterns. Just as tax hikes can push inflation up, tax reductions can contribute to disinflation, a slowing of price increases. For instance, cutting taxes on essential goods can make them more affordable, easing inflationary pressures in the PCE index. Policymakers sometimes use targeted tax cuts to achieve this effect. Announcing future tax changes can influence inflation expectations. If people expect higher taxes, they may accelerate purchases, temporarily boosting demand and prices. Conversely, anticipated tax cuts might lead consumers to delay spending, putting downward pressure on inflation. These expectation effects are important for understanding short-term fluctuations in PCE inflation. Taxes can affect different income groups in different ways. For example, sales taxes tend to be regressive, hitting lower-income households harder. This can influence the overall pattern of consumption and, by extension, PCE inflation. Policymakers must consider these distributional effects when designing tax policy. The duration of a tax change matters. Temporary tax hikes or cuts may have only short-lived effects on PCE inflation, while permanent changes can alter long-term inflation trends. Understanding the expected duration of tax policy helps forecast its impact on inflation. Tax policy doesn't operate in a vacuum. Its impact on PCE inflation can be influenced by other government actions such as subsidies, price controls, or monetary policy. For example, a tax increase might be offset by subsidies that keep prices stable, moderating the effect on inflation. Measuring the true impact of taxes on PCE inflation can be challenging. Changes in consumer behavior, market dynamics, and data limitations all play a role. Economists use various models and statistical techniques to isolate the effect of taxes from other factors influencing inflation. Advances in technology can change how taxes affect PCE inflation. For example, online shopping platforms may help consumers find untaxed or lower-taxed goods, reducing the impact of local sales taxes. Technology also helps economists track price changes more accurately. The rise of digital goods and services presents new challenges for tax policy and inflation measurement. Some digital products may be taxed differently or not at all, affecting their prices and the overall PCE inflation rate. Policymakers are still adapting to these changes in the digital economy. Tax evasion can also influence PCE inflation. If businesses or consumers avoid paying taxes, the expected price increases from tax hikes may not fully materialize in the inflation data. This makes it harder for policymakers to assess the true impact of tax changes. Some tax policies are indexed to inflation, meaning tax rates or thresholds automatically adjust as prices rise. This can help stabilize the impact of taxes on PCE inflation over time, preventing bracket creep or unintended tax increases due to inflation. How governments communicate tax changes can influence their impact on PCE inflation. Clear, transparent communication helps set expectations and reduce uncertainty, making it easier for consumers and businesses to plan. Poor communication, on the other hand, can lead to confusion and unpredictable inflation effects. Taxes don't just affect consumers, they also influence business investment decisions. Higher taxes on inputs or profits can raise production costs, leading to higher prices for consumers. Conversely, tax incentives can lower costs and help keep prices stable, affecting PCE inflation indirectly. Tax policy can also influence wage growth. Higher payroll taxes may reduce take-home pay, affecting consumer spending and demand. If businesses raise wages to offset higher taxes, this can feed into higher prices and PCE inflation. The interplay between taxes, wages, and prices is an important part of the inflation story. Taxes on imports, exports, or specific supply chain stages can influence the prices of finished goods. For example, tariffs or excise taxes on raw materials may raise production costs, which are then passed on to consumers. These supply chain effects can show up in PCE inflation, especially for goods with complex production processes. Tax rates and structures can vary widely across regions, leading to differences in local PCE inflation rates. For example, states or cities with higher sales taxes may experience higher inflation than areas with lower taxes. These regional differences are important for understanding the full impact of tax policy. Different demographic groups may be affected differently by tax changes. For example, older adults may spend more on taxed healthcare, while younger people may be more affected by taxes on entertainment or technology. These demographic effects can influence the overall pattern of PCE inflation. Changes in tax policy can alter what people buy and how much they spend. For example, higher taxes on luxury goods may shift spending toward necessities, changing the composition of the PCE basket. These shifts can influence measured inflation even if overall spending stays the same. Frequent or unpredictable tax changes can increase inflation volatility, making it harder for consumers and businesses to plan. Stable, predictable tax policy helps keep inflation steady and supports economic growth. Policymakers aim to minimize volatility when designing tax systems. Some tax-driven price increases can become persistent if they lead to higher wage demands or ongoing cost increases. This persistence can make it harder to bring inflation back down, especially if expectations become entrenched. Policymakers watch for signs of persistent inflation following tax changes. Economists use models to forecast how tax changes will affect PCE inflation. These forecasts help guide policy decisions and inform the public. However, forecasting is challenging due to the many factors that influence inflation, including consumer behavior, market dynamics, and global trends. Sum up, taxes can influence PCE inflation through direct and indirect channels. Sales and excise taxes raise prices directly, while income taxes affect spending power and demand. The overall impact depends on tax type, market conditions, consumer behavior, and policy design. Understanding these relationships is key for effective economic management. For policymakers, understanding how taxes affect PCE inflation is crucial for designing effective tax and monetary policies. Well-designed tax policy can help stabilize inflation, support economic growth, and protect vulnerable groups. Ongoing research and data analysis are essential for making informed decisions. In conclusion, the relationship between taxes and PCE inflation is multifaceted and dynamic. By understanding the mechanisms at play, we can better anticipate how tax changes will affect prices, spending, and the broader economy. Whether you're a policymaker, business leader, or consumer, staying informed about these connections is vital for navigating today's economic landscape.